The Bank of England is sticking to its script that the current spike in inflation is down to global issues that may well prove temporary. And the coming week will see the latest test for that theory. On Tuesday, the 16th of November, we've got the latest UK unemployment and wage growth data. And then on Wednesday, the 17th, central bankers, as well as economists and investors, will get to peruse the latest batch of inflation figures. Just by way of reminder, in the 3 months to August, unemployment was 4.6%, a figure seen only rarely since records began in the early 1970s. That meant, however, that 1.55 million people were still looking for work. However, job vacancies did hit a record of 1.1 million, and wage growth was 8.3% year on year, including bonuses, and 6.3% excluding them. Now, with unemployment of 4.6%, wage growth of 6% plus, and the Office for Budget Responsibility forecasting GDP growth of 6% plus for 2021 and 2022, you might normally expect the Bank of England to be jacking up interest rates pretty quickly, not keeping them at a record low of 0.1% and keeping quantitative easing running too. However, some would argue that at least some of these figures are deceptive. The UK claimant count is still 2.1 million, to suggest that a lot of workers and their families are struggling to get by and are in need of extra financial support. And that's before the recent jump in heating and fuel bills. The Office for National Statistics also argues that the wage growth number could be a bit misleading, owing to the base effect caused by the now expired furlough scheme and the effect of the pandemic and the lockdown a year ago. Whether you buy into those theories or not, so that's something that only you can decide. But the inflation numbers on Wednesday the 17th will be benchmarked against wage growth for certain. If wages are running faster, then workers are better off in real terms and more likely to spend or even save for the future. If prices are rising faster than wages, however, then workers' ability to spend and desire to save could both be crimped. In September 2021, the Consumer Price Index, or CPI, rose 3.1% year on year, a fraction slower than the 9-year high rate of 3.2% in August. The Bank of England's preferred CPIH measure, which includes housing costs, rose 2.9%, and the Retail Price Index, or RPI, rose 4.9%, although this is no longer an officially recognised statistic. Wonder why. There'll be plenty for investors to ponder when it comes to corporate news too, with 16 FTSE 100 firms scheduled to release results or trading updates, and a good number of mid and small caps set to do the same. Names which may be worthy of further study because of what they say about themselves, their industry, or the economy could include the following, although some of these dates could change at the last minute. Kainos on Monday the 15th of November, Imperial Brands, Land Securities, HomeServe and Premier Foods on the 16th, SSE, Smiths Group, British Land, Spirax Sarco, Informa and Experian on the 17th, National Grid, Royal Mail, Halma, Biffa and Speedy Hire on the 18th, and Kingfisher, Great Portland Estates, Telecom Plus and Wincanton on the 19th. The company which could just cause the biggest fuss in the week ahead is Vodaphone. The telecoms giant's due to report its first half results on Tuesday, the 16th of November. The shares have done virtually nothing in the past 12 months as they're no higher than they were a year ago. And in fact, they're trading no higher now than they did in 2002, when the technology, media and telecoms bubble was starting to burst. May's full-year results didn't go down that well, as Vodafone targeted mid-single-digit percentage growth in earnings and cash flow going forwards and a minimum dividend of 9 euro cents a share. That seems to have disappointed some, even as boss Nick Reed pointed to a major reshaping of the business, thanks to 5 disposals, 4 acquisitions, 3 mergers and 1 demerger across the group's operations in Europe and Africa, which are now the strategic focus of the company. July's first quarter update didn't rouse investors either, even if total service revenue growth was 3.3% year on year, ahead of analysts' expectations and the second straight quarter of growth, as the firm began to shake off the impact of the pandemic, lockdowns, and the hit to roaming revenues in particular. Besides looking at the trend in quarterly revenue growth, analysts will look to benchmark these first half results against 2 pieces of guidance that management has offered for the full year. The first is that underlying adjusted profits will come in between 15 and 15.4 billion euros. Based on the metric of EBITDA, or earnings before interest, taxes, depreciation and amortization. The benchmark is last year's 14.4 billion number, and the consensus analyst forecast is currently looking for a 5% increase to 15.1 billion, kind of towards the low end of the forecast targeted guidance range. The second number is that free cash flow will exceed 5.2 billion euros before spectrum costs, which could still be fairly hefty depending on when auctions for 5G spectrum takes place. Now that implies an advance of at least 4% from last year's 5 billion euro outcome. Then finally, investors and analysts will move on to the dividend, which is, as noted before, paid in euros. After a big cut to 9 euro cents a share in the year to March 2019, the company's first ever reduction in its distribution, Vodafone kept the payment unchanged in fiscal 2020 and fiscal 2021. The company is looking to develop what it calls a progressive dividend policy, but analysts are again looking for no change this year, particularly in light of Mr. Reid's guidance. That implies an unchanged first half payment this time around of 4.5 euro cents, although currency movements may mean the figures in sterling move around a little bit more. Note that this final graphic shows the dividend progression in pence, and also remember that Vodafone continues to run a share buyback programme. I hope that you and your families are all in good health and good spirits, and thank you for watching, and I look forward to seeing you again next week.